If you are a company director and you think dividends are always the tax-free magic bullet, stop right there. You are likely leaving thousands of pounds on the table every single year. There is a dangerous myth in the business world that salary is taxed heavily, so just take dividends. It sounds smart, it sounds efficient, but it ignores one massive hidden reality: the corporation tax. In this video, we are going to settle the score once and for all. I'm going to walk you through the two-layer trap that catches most directors off guard. We will look at the hard numbers using a real-world example, and I will give you the exact golden ratio of salary to dividends that optimizes your tax position while keeping the taxman happy. My name is Feroz Khan, and as an ACCA member, I don't deal in generic advice. I deal in facts. Let's dive in. Before we pick a side, we need to understand the playing field. When you run a limited company, your money doesn't just get taxed once. It moves through two distinct layers. Layer 1 is the company layer. This is corporation tax. Your company pays tax on its profits. Layer 2 is the personal layer. This is income tax and national insurance. This is what hits your personal bank account. Here is why this matters for our debate. Salary is a business expense. When you pay yourself a salary, the company gets to deduct it before calculating corporation tax. So a salary reduces the tax and layer 1. Dividends are different. They are paid out of post-tax profits. That means your company pays corporation tax first and then you pay yourself. So the assumption that dividends are cheaper is dangerous because it ignores what happened at layer 1. You might save a few percent on personal tax, but did you just pay 25% corporation tax unnecessarily? That is the real question. Let's break down the two contenders individually. First, the case for salary. Yes, salary attracts national insurance. In the UK, once you cross a certain threshold, you and the company both pay national insurance. That stings. It is an extra 25% cost effectively. However, salary is the only way to utilize your tax-free allowance. Effectively, if you have no other income, it's also the only way to trigger relevant earnings. Why does that matter? Because without relevant earnings, you cannot make huge pension contributions. If you want to dump 60,000 pounds into your pension pre-tax, you need a salary to justify it. Now, the case for dividends. Dividends are seductive. There is no national insurance, zero. For a high rate taxpayer, the tax rate on dividends is usually lower than the tax rate on salary. But there is a trap. Dividends do not reduce your corporation tax bill. If your company makes 100,000 pounds profit and you take it all as dividends, the taxman taxes the 100,000 profit first, which is currently up to 25%, and then taxes the dividend in your hands. You are being taxed twice on the same money. So how do we solve this puzzle? We stop choosing one or the other. We use a hybrid approach. The most efficient structure for most owner-managed businesses looks like this. You take a small salary and you take the rest as dividends. Why a small salary? You set your salary just high enough to secure your state pension record, usually at the secondary threshold for national insurance, but low enough that you do not actually pay any national insurance. This salary is an allowable expense. It reduces your corporation tax bill. Then you extract the remaining profits as dividends. Yes, you pay dividend tax, but you have already saved money by reducing the corporation tax bill by the salary. Let's look at the numbers. Imagine your company makes 100,000 pounds profit. Scenario A. You take a 100,000 pound salary. Your company profit is zero, no corporation tax, but you get hammered by income tax and national insurance personally. Scenario B. You take a salary of 12,570 pounds. and 87,430 as dividends. Your company pays tax on a smaller profit base because the salary reduced it. You personally pay a tiny bit of tax on the salary and the dividend tax on the rest. In almost every model I run for my clients, scenario B puts more money in your pocket than taking a full salary or full dividends. Before you run off and implement this, I need to warn you about three things that trip people up. As an accountant, I see these mistakes all the time. Mistake number one, the mortgage trap. If you're planning to buy a house in the next 2 years, treat carefully. High street banks love a steady, high salary. They get nervous when they see your income is mostly dividends, which can fluctuate. Sometimes paying a bit more tax for a higher salary figure on your payslip is worth it to secure the mortgage approval. Mistake number two, the pension opportunity. If you are looking to build a massive pension pot, dividends cannot help you. Dividends don't count as relevant earnings. If you want to utilize your full annual allowance of £60,000, you might actually need a higher salary to justify the pension contribution. It's a cost, but the pension tax relief often outweighs it. Mistake number three, losing benefits. If you take zero salary, you break your national insurance record. In 20 or 30 years, you might find you don't qualify for the state pension. That small salary I mentioned, it protects your future. So, is salary or dividend more tax efficient? The answer isn't one or the other, it's both. The winning formula is almost always a modest salary to cover your basics and protect your future, combined with dividends to extract the rest of your profit at a lower tax rate. But remember, tax laws change. The chancellor moves the goalposts every budget. What is efficient today might not be efficient next year. If you are an ACCA professional or a business owner, you need to stay agile. Don't set your payroll once and forget it for 5 years. If you found this breakdown useful, please hit that like button. It really helps the algorithm find other directors who need this advice. And if you want clear, professional breakdowns of business tax and finance, hit subscribe. I will see you in next video.